God knows what my background's going to look like, though. Oh, I can just do a, yeah, who's got time for that? There we go. That's okay.
Yeah, just don't move there, Andy, because you've got boxes behind you, and so long as you don't move, the pictures look good.
There we go. Thank you. Well, and I tilted up. There should be less. I've got a dry sink that was excavated from Nova Scotia, built in the 1830s, behind me as well. But I also do have some boxes.
So not only, just warning everyone, not only my 8-month-old with his 9 and 10 I just got notified that they're deciding to do fire alarm tests today at this very moment. So if it happens, I'm just gonna go mute, and I'm just gonna go like that, meaning you guys carry on the conversation, okay? The three of you, because we have a lot of people registered for this one. And here we go. So let's start with the introduction. Let's start with Sarah.
Hi. Hi, Sarah Hanks, CEO of CrowdCheck and managing partner of CrowdCheck Law.
Hi, I'm Andrew Korn. I am CEO of E5A Integrated Marketing. We are a systematic data-driven investor acquisition firm.
Marty Tate, securities lawyer, crowdfunding lawyer with Carmen Lenhoff Israel City in Salt Lake City.
Well, that's perfect. So welcome everybody once again for a wonderful afternoon. We are going to be having a great time here with the KoreSummit webinar series 2021. You met our panelists. My name is Oscar Joffrey. We're going to have a great discussion today. First of all, I just want to say we are 6 days away. So counting 1, 2, 3, 4, 5, 6. We are very, very close to the D-Day of where Regulation A goes live to 75 million. And this topic that we're about to engage in today is one that obviously a lot of people have a lot of questions about funds. And so let's start with the regulation. Let's get the one and only Sarah Hanks to give us why are so many people asking questions about it. I know I'm confused sometimes whether they can, and then I hear they do. I'd be interested to hear your comments.
That's right. I mean, one of the confusing aspects of this whole thing is that there are so many entities that have raised funds under Regulation A that are called fund. You know, the West Coast Single Family Housing Fund, 2015, 2016, whatever. But they are not funds as we would understand that term under the Investment Company Act. Because when you think of a fund, you're frequently thinking of an entity that invests in small bits of other entities, you know, like 5% of Tesla, and then maybe some NFTs and maybe some property. All of those things can be done as a fund, but that sort of fund, whether it's a private fund, a hedge fund, or whether it's a mutual fund registered with the SEC, none of those can use Regulation A or Regulation CF. There is, in both cases, both Regulation A and Regulation CF, there is a prohibition on an entity that is an investment company using those exemptions, and also with respect to companies that are exempt from the definition. Just to be super confusing, the prohibition for Reg CF is slightly different than the prohibition for Reg A, which means that you do get some of the real estate entities that invest in land, invest in dirt. They can use Reg A when they couldn't use Reg CF. But the basic principle is a thing that is what we would think of as a fund, a hedge fund or something like that, that invests in other companies cannot raise funds under Reg CF or Reg A. And I'm sure we're going to get into some of the exceptions or ways around that, but I'll bounce it back to you, Oscar, or the other guys.
Yeah, my alarm. So I only have 1 minute, so I better hurry. You guys like that? Cut Oscar down to 30 seconds. I think that's the reason why I get confused, because I get clients that say, they go, I'm going to do it for a fund, and my lawyer told me that I can, and I'm going, I'm confused, right? So I brought Marty in because obviously you both know him, who he is, and the space, and he is doing that. But there is, I don't want to use the word a way around it, but there is a way to use the exemption in a way that it doesn't violate the securities exemption. So Marty, if you can touch into, she's gone through the regulation, now touching to the point, how can we use it if from the fund perspective?
Well, one of the things that, and Sarah did a brilliant job, and I told Oscar before Sarah joined on, I said, I basically every answer I should just defer to Sarah, because she is the absolute guru in this space. But I do a lot of fund formation work, and combining that with Reg A has been something that we've, obviously there are groups out there that call themselves funds. I will say that the SEC doesn't like it when you call yourself a fund. Sometimes we have funds and they make us, that we're trying to qualify under Regulation A+, and they ask us to change the name. But in order to utilize Reg A+ for a investment type company, you have to be exempt from being an investment company. So as Sarah said, one of the and you can't rely on the exemptions that most people typically rely on, which is a 3C1, which is less than 100 investors, or 3C7, which is certain qualified investors. So you have to try to fall under another exemption. And what most people do is they say, well, we're not investing in securities, we're investing in real estate, or we are investing in some other type of interest. And that's where the argument generally goes, is you're saying we're not, an investment company is somebody that invests primarily in securities, and you say we're not investing in securities, and we fall under one of these other exemptions that I'm sure we'll delve into more.
So I get asked this question all the time as well. And of course, I'm not an attorney. And when it comes to structuring a deal, I'm also not an investment banker. But I have been a lot of deals, and more than anything else, I've gotten tutored by Sarah Hanks. So I know the answer to a bunch of these things. But the questions I get all the time are from our real estate clients. They'll say, hey, we're a real estate private equity fund. We want to do something retail. It's moving up to 75 million. Could we do our next fund that way? And the answer, of course, is no. You can't be a 40 Act fund. You can't be a private equity fund, but you can create a C Corp holding company and then have shareholders. And there's a lot of positives and negatives that go along with that. The other requests we get all the time are things that resemble venture capital funds. And again, we say you can't do that, but you can do a holding company. So I can go through some of the marketing reasons why a company would embrace this, because it's something we've been dealing with. We now have several clients who are doing this. So I can get into those aspects, but I really want to yield more on structure and why it tends to go that way to the holding company. And if there are other structures, then I'd love for the lawyers to be able to hash that out.
If if I could just jump in on the structure thing, it doesn't have to be a C corp. I mean, it can certainly be an LLC. And of course, one of the things that you want to be clear here is if you are an LLC and thinking of doing a Reg A, now would be the time to consider whether you might want to convert to a C corp. Always do this with tax advice from qualified tax counsel, but now would be the time because it is easier. Sometimes it's easier to have a C corp, which of course is subject to dual taxation at the entity level and at the shareholder level, as opposed to a pass-through where the tax does not, you are not taxed at the LLC, but you are taxed at the holder level, but you have to file K1s, which is, a pain. So now is the time to think about doing it before you go out to the public. But you can use LLCs in the same way as you can use C Corps as the holding company. And I just want to emphasize those words because I'm sure we're going to get to it later. A thing like Warren Buffett has, which is a company that owns majorities of other companies, not a fund, can use Reg A. And we're seeing some companies who are planning to be Warren Buffett's using Reg A. But I'm going to bounce it back to Andrew, because I interrupted him. So
you didn't, and that was exactly some of what I was looking for. And if Marty, if you want to add something, please feel free, or I'm happy to review some of the marketing reasons of why these entities end up working out well for issuers.
I think the key is just that, and what Sarah said is correct. If you're holding, and that is an exemption, right, Sarah? That you're investing in these majority-owned subsidiaries. That's something that as long as those have fall under an exemption, then that would be permitted. It's in my experience, and Sarah, I'm sure you dealt with this as well. Every time you sort of create this structure and you file your 1A, your offering circular, that's something that you have to address. You have to address, why you are not an investment company. And sometimes the SEC will, buy your argument right away. And sometimes they'll say, well, we might want you might need to explain it better or give us a better argument as to why you're not an investment company. But that seems like something we're always having to address.
Yeah, I think that's a good point, and that the one of the things that's important in this area is, of course, when you file with the SEC, the people doing your review are going to be one of a number of different branches. Excuse me. The real estate branch is very used to fund-like things, and providing that you have an entity that invests in majority holdings or owns the land or can touch the land by getting there through a mortgage or whatever, it's easier sometimes to have that conversation with the real estate branch than with some of the other branches who haven't seen things that want to call themselves funds. So the conversation can be a lot longer with the other branches.
So and one of the reasons I think I was invited to join what could be a technical conversation is some of the very practical things that come to structuring the deal from a marketing perspective or an investor acquisition perspective. So one of the first questions my firm asked during our onboarding process is, what do the investors get? Because if they're investing in a C Corp, think of it almost as permanent capital. They're buying shares of a company. So our question to the company is what do they get back? estate, it's usually a fairly simple answer. They're going to get X% preferred return or dividend in this case every year. And is that payable quarterly or monthly? And that's a big marketing conversation as well as a practicality conversation. So we get into that. But then how do they get their money back? Well, over X number of years at X%, they'll have their money back. But let's say they're investing in a bunch of different multifamily. What happens when a building is sold? Do they keep that money and buy the next one? Are they going to do a special dividend? And what do they want to promise, being that they can't foresee the future? So with the structure comes a bunch of very practical challenges of predicting the future. What is the intent, and how are the investors going to benefit from all of this? So that's a big focus of ours. Now, if you take this one step further into something that is similar, more like a venture capital type structure, and we have 4 of those we're working on currently, they will have to have similar answers. How are they going to get money back into the pockets of the investors? And if they end up investing in 10, 15, 20 companies, which they need majority share of, it's not a minor holding like a VC firm, they need to again explain how are they going to return capital eventually to shareholders. And also, as you as an issuer, do you want to commit to permanent capital and run this for a long time? So, you know, a lot of these questions come up in marketing as opposed to a little earlier when structuring the deal with the attorneys, but it always comes back to a conversation with the attorneys sooner or later.
That was an interesting thing that you mentioned there, Andy, that the holding company structure, and because this is one of the deals that you and I are working on at the moment, and this takes us to, you know, one of the areas where you really have to thread the needle very finely with the SEC when you're not going in there as a holding company. You know, Warren Buffett, I own majority stakes in this railroad and this insurance company, whatever. You're going in with aspirations, and you're going in saying, I am planning to be a holding company, not a fund, holding company. I am planning to acquire majority stakes in various companies, but don't have any yet. And so one of the first things you've got to get over with the staff is them looking at you and saying, you look like a SPAC to us, and SPACs can't use RegA. And of course, the concept of a SPAC is we're going to raise money from idiot investors who think that it's cool that the Kardashians are raising a SPAC. Sorry, I can be negative about those things, but you know, you're raising money from punters who think that you're probably going to have better deal flow than them, and you're going to find the amazing company, which of course you are going to overpay for. But we'll set that aside. You can't use the SPAC structure. And a SPAC is we're raising funds, it's blank check. You're going to give us money and you're going to trust us to go find something good. Can't do that with RegA. For RegA, you have to have a specific business plan. You can't be planning to merge with or acquire an unidentified company. So you have to say, this is our business plan. It's very precise. We're going to look for companies with these characteristics, and we are going to acquire them. And one way that you can prove that you are not looking to invest in unidentified companies is to identify the companies. Now, once you identify the companies, you got a different set of problems, because once you identify the companies, if their acquisition is probable, you have to get audited financials for them. And if you're just entering into letters of intent with a number of different companies that you hope that you'll be able to raise enough money to acquire them eventually, they don't have audited financials yet. So the needle that you have to thread there is, they are not unidentified. These are possibly targets of ours, but they are so conditional because the acquisition in the letter of intent is so conditional that we only acquire them if we raise enough money, that we cannot say the acquisition is probable, so we don't have to produce the financial statements. SEC is not keen on that sort of thing. And you have sort of ongoing discussions with all of those. In the meantime, after you've identified your target, somebody who is a private venture company, venture capital fund, comes in and says, oh, these are good things that you've identified here. Here's our shopping list, and goes and buys one of them. It happened to us very recently. So there is a very, very fine line that you have to walk in setting up that kind of structure. And I think, I'm getting the vibe from the SEC that they really don't like it, because it looks kind of SPAC-y to them. And we're not supposed to use RegA for SPACs, but we're not.
Yeah, it's interesting because you're walking that fine line with funds, and I'm a former fund manager, and basically you have an exact investment process. And from a marketing perspective with the holding company, that again is what we're trying to get across. Here's our criteria. Here's what we're looking for. Here's what we believe we're going to do. And then a lot of them will have specialties. We're only going to invest in software as a service, or healthcare, or clean energy. But all of them end up being fairly blank checky in a way, for all the reasons that Sarah stated. But what I find fascinating is they're no more blank check than the real estate companies that get a pass much faster, because they haven't identified which buildings they're going to buy, or anything else like that. So it feels a little bit like a double standard to me, and that has definitely come out in some frustration.
I think that's absolutely right. And we see this sort of real estate, non-real estate split in several different places, because the real estate funds can go out as a blind pool. We have or do not have a track record. We're going to buy single family homes on the East Coast. Boom, you can go out and do that, and give us money and we'll go find those things. But if you try and take that model of give us money, we will buy an asset, and apply it to different asset classes, you get comments along the lines of, well, we don't think you can, you actually have to own the assets the same way as, a lot of the collectible RegA companies, the guys who own the sneakers, or the guys who own the racehorses, which is, by the way, something we should talk about, is racehorses in general. But, identified assets is one thing, blind pool of assets. Some of the non-real estate branches are looking at and saying, I don't think you can do that. And we're saying, you can with houses. How is it different with bottles of wine, for example?
Aren't most SPACs already publicly traded entities where most RegAs are remaining private?
Yeah, a SPAC is a public company, and a RegA is it's a private company that's done a public offering.
Is that not enough of a distinction for the SEC?
No, I'm not going to try and read minds there. But sometimes the inconsistencies can be a challenge.
Sarah, didn't you brought up a good point about some of these, like the collectibles, and having to identify what those are, and those are a lot of times are being offered in a series, and you're saying, okay, this series buys this racehorse or this automobile or this package of assets, which is I think a distinguishing factor, because that you are identifying those, which makes it a little bit different than a fund or a blind pool. I was just thinking about it from sort of the investment advisor angle, which is a lot of times these groups, will avoid that because they're saying we don't have discretionary control over where these funds are going. These funds are going into this specific set of assets, which is, a little bit different. And I think that's, one of the reasons why that with collectibles and stuff that model has been adopted. I don't know. I couldn't think of any off the top of my head, but are there any blind pool RegAs that are going out and doing collectibles?
There will be when we get them through the SEC. We've got one at the moment, but that's it's a really it's a really good point. The identified assets and the role of investment advisor, because as you say, if you've got an identified asset, you don't have somebody going looking for an asset. So you don't have an investment advisor, and you don't have to answer the question as to whether the person is an outside advisor or an officer of the company, and does he need to be a registered investment advisor? Because here's the asset, here's the racehorse, here's the shoe. But if you have a blind pool of non-real estate assets, you're going to have to answer that question as to whether there is an investment advisor in the loop or not.
The reason why I asked that, Sarah, and I'll have to look at that, but is there an argument that those collectibles are not securities, so therefore you're not you're not an investment company because you're not investing in securities, you're investing in shoes or whatever, right?
It's a really good argument, and I'm not sure if there is a standard answer to it yet, but I mean you've hit on one of the most important things about that. Is one of the things you have to look at is, are the things that are going into the series or the blind pool or however you've set it up, are they securities in and of themselves? And just to be for the lawyers watching, yeah, the Howey test, we're going back to the oranges, right? Whereas the oranges themselves are not securities, but the interests in the whole structure are. And you have that and with some assets as well. So for example, a part share in a racehorse. If you are investing in the company that owns the whole of the racehorse, fine, you own the racehorse. But if you are taking minority interests in the racehorse and somebody else is doing the work, someone else is deciding who the jockey is and whether the racehorse takes drugs and where it will live and what it will eat, then the interests in the racehorse owning company are securities, quite possibly. And so you've got to work out whether you're investing in the securities and whether you're going to trigger the 40 Act definition by reason of having 40% of your assets in in quote investment securities. So that happens with racehorses. Sneakers you tend to own outright. I don't think there's any sneaker management companies, but that's one of your gating issues always in a blind pool asset investment vehicle or in a series is the thing a security, because horses like oranges can be securities sometimes.
Interesting. I'm currently working on and this is a whole other area, but currently working on it's not necessarily a fund, but it's a company that is investing in oil and gas interests, which we had to kind of navigate this because you have the Investment Company Act considerations, but then you specifically under RegA, you can't offer undivided interest in mineral rights. So that became, we had to go through and actually ask, well, we're not offering those. So there's a lot of different things, and I'm sure Sarah, you deal with this as well. There's all these different silos of regulations, like we mentioned the Investment Advisory Act and the Investment Company Act and RegA, and all of these different things you have to navigate in structuring these deals, and especially and they become a lot more relevant when you're talking about a quote unquote fund.
Yep, exactly. I mean, it's interesting that you raised the undivided oil and gas interest, because I once called the SEC and said, okay, where's this defined? And they're like, we don't know. Yeah. Like, do you have any guidance as to what exactly that means? And I don't know if you got an answer, but I'm going to look to you next time I have an oil and gas question.
Yeah, what the answer that we got back from the SEC was, you can offer, you could offer equity interest in this company that then turns around and invests in mineral rights and oil and gas interest. That's fine. You couldn't do a RegA offering that just directly offered the oil and gas interests. So you couldn't, we're selling oil and gas interests under RegA, but you could sell, you know, LLC interests or limited partnership interests or whatever, or common stock in an entity that goes out and buys those.
So, it's interesting because, I mean, you know, you're going to have to do the same analysis there too, as if the company is investing in interests which are minority interests and held by somebody else. Yeah. Every layer down, all the way down. You go check for the turtles all the way down.
Yeah.
So we are always looking for, gee, what do we believe will raise capital? And, you know, a lot of that has to do with the investment process. And it is so similar to working with a fund. What is the process? Is it repeatable? Is it scalable, where if you raise a lot of money, you'll be able to invest all the money? What's the time frame? Are you going to be sitting on the cash? If you're paying a preferred return or a dividend and you are advertising a number, if you don't invest the money quickly, will you be able to fulfill that, or will you have to do a return of capital, which, oh, you can advertise as tax-free, but it's just giving people their money back. That's why there's no tax on it. And it's kind of a bogus way of doing things. So all these things come into play when looking at how it's going to work. I've now encountered a RegA Plus, which is raising money, trying to make an acquisition, stalling, raising more money, and kind of playing chicken with the 12-month window. And that way they are acquiring, and they're trying to acquire 100% of the companies, so they truly are a holding company. So there's a lot of dances that are being done around this, and I'm not sure how much of it is phobia of the SEC, or if it is, gee, we see this opportunity right now, we don't want someone to come in because we've identified them and swoop in and buy them. So there's an awful lot going on in this space, but I do think it's very exciting, especially with a really good, solid management team that's got a track record that has invested successfully before. And certainly offering those types of investments to regular, everyday individuals, I think is super different. You know, it's hard to get a diversified portfolio of privately held companies with a reasonable stake doing it any other way, without doing huge due diligence yourself. And of course, you want to invest in this company because you want their due diligence and their experience, et cetera.
Yeah. So that's a really good point. And I think you've just identified one of the great disappointments to me in all of the rule changes. The rule changes that go into effect next Monday, they were kind of the low-hanging fruit, regulatorily speaking, of the proposals that the concept release that the SEC released in 2019. And they were talking about very broad-reaching, like, should we regulate sales instead of offers? You know, you can say what you like, but when you actually sell, that's when liability attaches. And I'm very much in favor of that and always have been. They didn't do that. One of the things that they raised is something that the former chairman, Jay Clayton, was very keen on, is, you know, mini funds, you know, hedge funds, taking advantage of Reg CF or Reg A, investing in early stage companies. And then the idea being that, you know, if a crowdfunding investment of $500 in a small company is one thing, $500 invested across 10 companies is a different, safer, more diversified thing. And it would have been nice if we could have had little baby mini funds that gave investors, if you could just say, hey, I'm going to take, you know, everybody who invested on WeFunder or Start Engine this week. That would have been kind of neat. And it would have been a huge regulatory lift. You got to change so many regulations on the 33 Act and the 40 Act and the Investment Advisors Act. And I can see why, you know, it didn't happen. But I do regret it. I don't think it's going to happen now for, you know, for the next through this administration. And it's a shame, because it would have been nice if Grandma has already a diversified portfolio. If she's got her emergency funds, she's got her 401k, and she's got a bit of play money, why shouldn't she be able to diversify across a few nice startups? It's a shame.
Yeah, you know, I'm seeing that as people are looking for income, and you know, I'm not a professional investor anymore. I'm not offering anyone any personal advice, but there are a bunch of alternative energy deals where I've said, gee, they're making electricity from sunlight and they're paying 7%, and they have a contract from a state that's a pretty good deal and relatively secure. Certainly not FDIC insured, but you're also not getting 0.5% at the bank. So that might be something you want to do. And a lot of these deals, you know, there's no pie in the sky on them. You know, most of these, you know, recapping a bunch of solar deals or wind deals, you're going to get your percent. They don't even own the land under it. You know, you're basically investing in this contract between the company and the utility. But you are part of clean energy and you are going to make your nice interest rate. So every deal needs to be looked at, gee, you know, what are you doing with this? So I agree with you, Sarah. It would be great. I, who have some expertise, could invest in 20 of these and do it for hundreds of other people and do a RegA plus, you know, based on, you know, being a fund of investments. But I don't believe that that is something that you're allowed to do. But I have noticed my portfolio of CFs has been growing quite a bit. Some of that is just testing technology on different platforms, but from my perspective, the only way to test it is to invest. So it's been an interesting journey.
It's a shame that there were some things I would have liked to have seen the SEC ease up on. One thing I just wanted to flag, as if anybody's thinking of doing some fund-like holding company-like thing, one of the more successful routes through the SEC is to actually have a business to start out with. So you're not going in as a blank check company. You've got a teeny little business, and you've acquired it, and you've got your audited financials, and it's maybe, you know, generating $500,000 a year, and you raise money for it, and it's going to expand into an empire. And that seems to have had a much easier trip through the SEC than the the guys who have nothing. So buy some piddly little thing that just happens to have audited financial statements. I know the SEC, if they're watching this, they're going to be this is terrible advice, but that process seems to have been successful, and it is, of course, absolutely legitimate. You've got a company, and they're really the examiners are sort of focusing on the company itself, and it's also a good example. You say, we are planning to build, vegetarian restaurants, and here is the first one, and we actually have one, and we plan to acquire a whole bunch more. And so they can see this is what they're all going to look like. But it does seem to be a little bit of a nice, I won't say an end run, it's like a shortcut. There's less hassle when you actually have a thing that you can show them.
Could you then buy a soup company and then maybe buy some farm, an existing organic farm, and then buy...
if you said you're going to, yeah.
No. That's funny, Sarah. That's an approach that we're looking at right now with a client, that they have a, part of, really what they want to do is be this conglomerate and buy up make these different investments and buy up these companies. But right now, they're sort of what's paying the bills is they do some software development. Mm-hmm. So that's what we are, with a software company that plans to expand. So, but yeah, we haven't started on it, but that we've had that discussion, and that's so that's interesting you brought that up, because
Yeah, I can give you the name of one of the companies that that one of my later clients modeled themselves on, but the company that made it through so easily had exactly that. We've got a teeny little thing, and we're going to acquire some other little things, and then some more bigger things, but the teeny little thing seems to have helped get through the SEC.
Oh, that's great. One point that Andrew made earlier, and just that I think is, as I kind of mentioned all the different areas that you have to navigate through and structuring, and I'm not a tax lawyer, so but a lot of these things, like Andrew was saying, really get driven by, I think the tax ramifications and how it's structured, and so many of those things, and that's why you see the real estate deals, a lot of those are offered as REITs, which again, that's just a tax classification, but it's crazy how many questions we get about, even that level of the implications, the tax implications. So yeah, it's just another thing to think about, because like Sarah said, if you go out as a fund, as an LLC, and you're taxed as such, and you raise a lot of money from a lot of investors, that could be administratively really difficult. And so some people don't like that, but then they don't like the double layer of taxation. So
well, yeah, even the number of shareholders based on, is there a limitation with an LLC? One of the first things we say to an issuer early on, well before we're engaged, is, do you want 10,000 shareholders? Because if you're going to raise $50-75 million, you're going to have that. And that's the whole idea behind RegA, or you're going to have 5,000 investors for a Reg CF if you're raising the $5 million. So, that needs to be part of the business plan. Anyone who wants a clean cap table with 10 investors on it should not be looking at anything that has the word crowd in it.
That's right. Although one thing I should just flag, because I'm sure people are thinking about it at the moment, next week in Regulation CF, but not Regulation A, you'll be able to use crowdfunding vehicles. Are they funds? No, they are not. They are just a way to protect against triggering the registration requirements of the Exchange Act of 1934 by putting all of your investors in an SPV. And the way we are structuring those things is the SPV is just sort of married to the company. The SPV holds the underlying shares, issues SPV interests, but there's no daylight between them. And as far as the investors are concerned, they're probably, they are going to see this as communications with and between the company. They're probably not going to even focus on the fact that there's a level of securities between them and the company, but that's not a fund. It doesn't change. It's just a manner of holding change. That's all it is.
And the purpose of doing that is to clean up your cap table for an IPO or for a VC round?
The thing is that people talk about, the messy cap table and clean up the cap table. On the company's cap table, there's going to be one, so long as all of the investors are natural persons, there'll be one in a crowdfunding SPV. But then underneath it, and the company's going to be responsible for making that happen, underneath the crowdfunding SPV is going to be all of the crowd. So your cap table, it's messy, but it's messy at one remove. It's still there. The crowd is still there.
How can it be messy? No. I think Mark Roderick said it best. Do you remember that conversation we had with Mark about the whole thing? People saying that we got to stop having that conversation.
Yeah, I know. It's a silly conversation to start with, because you can always have a cap table that just says the crowd, and then you can expand it. I mean, the software of the sort that you provide at KoreConnect means that is actually a meaningless discussion anyway. But if you were concerned about a messy cap table, it's not going to change it really. It's just moving it down to a different place.
Yeah, I was just going to say that. I think Mark brought up a really great point, which was you just added more cost and more like you can now two entities. Yeah, we'll get into that. I have a twist for all of you. You guys have been great, by the way. I have to tell you, I heard everything. You didn't get to hear the alarms. So thank you, Andrew. I just want to make sure I say that. So obviously, Regulation A allows both a U.S. and a Canadian company. We've been talking a lot about C Corp and LLC, which is a U.S. structure. That doesn't exist in. So how does a Canadian fund, or what has anybody experienced this yet? Or maybe I should start from there. Marty, have you had anything from Canada in that direction? No.
No, I have not. I have not done it. I have not done a RegA for a Canadian company. Sarah?
I've done a couple, or actually a few, with various different structures. One I think would arguably be a real estate company, but it was very much a sort of very traditional blind pool. Give us money, we'll buy stuff. Just the stuff just happened to be in Canada.
Okay, so no, I just thought maybe there was a different type of structure because. Look, every single day, it's either people go, can I use a fund or can I use a fund? But, what I heard through all of this is you better talk to a lawyer before you better start talking. And I did hear you say this, Marty. You said it a few times. The SEC does not like the word fund. That is correct, right? When it comes to Reg A?
In my experience, that's they frowned upon that. I don't think it's like prohibited, but it's definitely something and it's just, from what I can tell, it's just because they say, well, you can't use a Reg A plus for a fund, so you can't call it a fund. However, if you do a search, there are Reg A pluses that have the word fund in them. And so it's not a hard.
It's not the end of the world. Okay. And no, just that I've been confused. So I feel bad now because I've always been telling people, no, as a fund, you can't use it. But I don't want to use the word workaround. There is a different structure that you can utilize. That's what it comes down to, right?
Which would mean not being a fund. I mean, so to go back to what Marty said, I mean, just like, if you're not a fund, don't call yourself a fund.
Okay.
So yeah, don't be misleading. And we try and dissuade our clients from using that word, the F word.
Yeah, and if I understand that correctly, by not becoming a fund, they don't need a fund administrator. They don't need to do K1s or NAVs. I mean, this is a great savings, right? Or do they still need to do all that?
Well, it depends on the structure. To go back to the conversation that Andy and I were having, is if you are an LLC, you do have the K1 issue. But the thing is, you don't need all of the trappings of true funds, but you do have all of the administration that goes with whichever entity type you chose, whether it's a C Corp, Canadian company, LLC, whatever. Those things don't change.
And you still can have it. I mean, depending on the structure, they still can use a NAV. I mean, that's something that it's pretty common.
Especially with real estate. Yeah.
Yep.
No, that's interesting. Obviously, we've got some people here. If anybody has any questions for Sarah, Marty, or Andrew, all you got to do is hit the little button there, raise hands, and we will bring you in to ask the question. But in the meantime, obviously, the conversation continues. We do have somebody here, Richard Ross. So here we go, ladies and gentlemen. Richard, ask away.
Thank you. Just want to clarify, it seems that if one is doing a Reg A plus, one should identify the operation and not have a blank check. That's sort of the antithesis of SPAC. If you're doing a SPAC, you have to be blank check, and you cannot have pre-identified the investment. Is that basically correct?
Yes, that is basically correct. Thank you.
And what's topic 11 of SPAC? If this is not too much of a detail, and if it is, I apologize, I'm gonna take it offline. But topic 11 of the SEC says SPACs can identify in certain cases what they're going after. Again, if it's too obscure, ignore it.
Yeah, I am, as you might have picked up from one of the things I said, I don't like SPACs, I don't do them. So I am completely ignorant on that space. Marty, anything?
Yeah, sometimes you'll see that. but generally, you know, I've worked on SPACs, but you know, I'm not an expert, and I think that a lot of times they'll be area specific. Again, that's SPACs, not RegA. So
yeah, perfect. All right, so let's continue. Obviously, the conversation is if there's others that have questions related to funds. So okay, so we started talking about some of the collectibles. We didn't go too deep into it, or I know, Andrew, you started diving into it, but you didn't get too much into it, because we're starting to see that now coming out more, right? And this is a structure that Sarah, we'll talk a little bit more. So let's finish this off with the collectibles, because it seems to me like every other day that seems to be the topic. Please.
Yeah, well, I mean, if I could start by saying, one of the things, we keep a record of all of the offerings that have been made under RegA, of which there are now 945. No, that's last week's numbers. So, you know, somewhere approaching 1,000. We code them, and I'm seeing more and more, you know, the tag A for assets. So, you know, you've got artworks, one of the earliest. Everything from, I think one of the very earliest collectibles was a trading card or a player card from Dungeons and Dragons, or maybe it was Mystic the Gathering or something like that. It was, you know, from one of the major games, and that's the sort of thing that is, you hope, you know, a counter-cyclical type of investment. It's completely different to operating companies, completely different to real estate. It's another asset category that investors should be considering. But you really do have to know what you're talking about, because in many cases, the way that these are presented to investors is somebody who does know the market goes out and gets the thing and then basically securitizes it. These are asset-backed securities in their purest form. And you want to know that that first thing that happened at a good market price, because if you overpaid for your sneakers or your trading card or your racehorse, then you're never going to make money on that.
Oh, sorry, Marty, did you want to add to that? My apologies. I almost got it. Almost got the alarm there.
No, I think Sarah, no, I don't have anything to add on that. She nailed it.
Oh, that's good. Well, you did say if anybody ever wants any of the questions and answers about Regulation A, we do need to go to Sarah. So there is one little thing that I want to demystify here. I know we're talking about Reg A, and quite often we talk about funds and people go, well, you know, if Reg A is too much of a hassle, I'll just do a Reg D with a Reg S, right? So the Reg S, oh yeah, it came in discussion 48 hours ago. And I just couldn't believe it that there are still people floating that idea. So does it change anything, the fact that it whether it's a Reg A or Reg S, or are they just talking riddles of exemptions that they're trying to get their way around to get non-accredited investors into the fund?
I think one of the most important things about Reg S, and I say this as the person who drafted Reg S at the SEC, generally it is not appropriate for any of this stuff. One of the starting points is if you're doing a Reg D and you're selling to accredited investors only, just sell to the accredited investors. If you're doing Reg D and S side by side, do you really need to sell to non-accredited foreign people? Do they have that much money? I mean, I know this does happen in crypto all the time, and this is where we've seen it most abused. But Reg S does not sit very comfortably with 506C, and we always advise clients, you do not use them side by side. One of the biggest reasons is that the Reg S cannot be obvious from the United States. You can't see it. It's got to be geo-fenced. You've got to make sure that when somebody from the US logs on to whatever offering site you have, they are not aware that there's a Reg S there. I tend to be very strict on this, and those of you who know me, I'm not usually very hard-assed about stuff, but this one, just don't do it.
Well, and to that point, if you have, I mean, Sarah was talking Reg B and Reg 506C and a Reg S, which is true, but Oscar, you had said something about a Reg A and a Reg S. I don't know why you would, I mean, you can just have the non-US investors, non-accredited investors, they can come into that.
Yeah.
They can invest in that. So that, I don't know why that would ever be a thing.
Yeah, right.
Unless they wanted to exceed, the limits on accredited investors. But then again, why?
Yeah,
Listen,
totally agree with that.
If you guys are in conversations, you know what it's like sometimes when you put people up against the wall, you keep telling them this can't be done, then they keep throwing other exemptions at you, and you're just like, okay, you know what, I need to revert back on all this. So, all right. I mean, look, this was very insightful. I know it's a bit of unclear. No, it's not unclear. Sorry. I think it's very clear. I think the key is, obviously, you can use the fund. It's not a fund. There are ways to use the regulation just in a different way. But no matter what, the key is starting to speak with lawyers. This is not one that you can just go out and copy off, Edgar, and say, they did it, why don't I do it? And here we go. This one requires a lot more thought process into it because you need to structure it properly. Otherwise, it'll backfire on you pretty badly. So any last remarks, Marty, and to this point for Reg A using funds?
Yeah, it's possible, I guess, is what I'm saying. Is it, depends on what you're doing. I think that, we always start with sort of the no and try to work, figure out the way to make it happen. Obviously, in the truest sense, it's not available, but there's lots of ways to make things work. So I was telling you, Oscar, that I've done a lot of fund formation prior, kind of separate from these security or these Reg A offerings, and so bringing those two worlds together has been, something I've enjoyed, but not without challenges, for sure.
Yeah, no, it's good. And Andrew, I mean, obviously you're on the marketing side. I mean, does it make a big difference, a closing remark, that if they don't get to use the word fund, it won't be as attractive, or does it really matter?
So
right?
From a marketing perspective, when the word fund is in there, it frequently implies a type of liquidity. We do a lot of work for exchange traded funds, marketing them both to advisors and to retail. And when there'll be a comparable deal in the private market, it's like, well, there should be a private company premium, meaning they should expect higher returns in exchange for giving up that liquidity. So there are a lot of nuances to all this, but the big advice that we give is to make sure that it's structured in a way that's going to get qualified. And also that you need some kind of track record. You can't get five guys and gals together and say, oh, we're going to start investing in this with no track record, no history. Because the first question I'm going to ask you before considering whether we would take you as a client is, how'd you do during the pandemic? That question used to be, how'd you do in 08, 09? Now it's going to be, how'd you do during the pandemic? If the answer is, well, we've never invested before, that kind of gives you a bunch of the answer as well. Because you can hear from the attorneys, it's not going to be easy to structure this and to get it qualified, without a history and a true plan.
Yeah, that you brought up an interesting point that I didn't even think of. I mean, obviously, we take it for granted that when people are applying for Reg A, the CEOs and founders know the space and all that. But a fund is different. You are taking on the responsibility of managing money, right? And however you may structure it, as you're doing, Marty and Sarah, ultimately is to bring a return on the investment. You're not really building, you're building in a different way. So it never actually occurred to me that that also plays into it as well. Sarah, your last remarks and comments as the one that knows regulation better than all of us. Thank you.
I'm not saying that, but yeah, just know what you're selling. To build on what Andrew said, you've really got to know. You've got to know what you're selling and why you're selling it, and what you're going to do with the money, how they're going to get the money back. The SEC cares about that. The investors care about that. And to build on what Marty said, just don't call yourself a fund if you're not really a fund.
Yeah, that's fair. And I have a few clients that don't call themselves that. They're just a holding company raising capital and they've never used that. So it's a great way to close off. Thank you again, all of you. You did a great job today. You didn't need me. That hurts me a little bit, but that's okay. But I'm glad the three of you had a great discussion, and obviously the audience enjoyed it. As always, we do record all our sessions. It will be available on our YouTube channel at Core Connection, of course, at KoreSummit.io. And for everyone else, don't forget, we are 6 days away of excitement, lots of discussions. And on March the 15th, if you haven't registered yet, we have what is called the State of the Jobs Act 2021 with the one and only Sarah Hanks, the father of the
People
Jobs
are going to get
Act.
bored of seeing me, Oscar.
Why? Why would they do that? And she'll be joined by David Wield, the fourth, father of the Jobs Act, and of course, Vincent Molinari, who will be playing host for that event. So thank you, everyone. Have a wonderful afternoon and week. I'll